Welcome, everyone. My name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We're glad to have you with us here today. You're going to hear a very interesting interview and conversation between Simon Singer, the founder of the Center for Tax Strategies and Resources, and preeminent tax attorney Bruce Givner. When their conversation ends, it's about 35-40 minutes. We're going to give you some information on our upcoming academy, which is next week. I think after you kind of listen to Bruce and Simon talk, you'll see the caliber of folks that we have set up for this 3-day event. So make sure you stay tuned at the very end, and we'll give you a special offer to save you a few dollars on registering for this monumentous event. All right, enjoy the interview.
My name is Simon Singer. I'm the founder of the Center for Tax Strategies and Resources. And our guest today, as a preview to his appearance at our academy next week, is a tax attorney in Los Angeles by the name of Bruce Givner. Bruce is one of the preeminent tax attorneys in the country, known for his attention to detail, his creativity, his understanding of the law, and understanding of human nature, all of which are extremely important in putting together meaningful strategies for our clients. Bruce works successfully with CPAs, other attorneys, people in the financial services business, whether it be assets under management or insurance people. He's been a wonderful and valued partner for years of people in that industry, including me. And just a little background, Bruce has got a master's in tax. Obviously, he's got his law degree, and he's 10 years younger than I am. So at this point, Bruce, say hello to our audience, if you would, and then we'll start out with a few questions.
Thank you very much, Simon, for that nice introduction. You left out the Heisman Trophy and the Nobel Prize in Chemistry.
I was going to get to that, but I'm glad you did it, because I really don't want to brag about you any more than I already do. So, Bruce, you started. I think one of the important things, because you've shared with me before, is one of the important things in your career was not only your basic intelligence and curiosity, but you had a lot of really good mentors also. Is that not correct?
Sure.
Yeah.
When I first started practicing, my boss, Howard Sanger, with whom I'm still very close, he's in Palm Springs, and he works, even though he doesn't have to work, but he continues working and is very good at things like probate accountings. But what he taught me was he was always giving speeches to CPA groups. And he always said, copy the CPA on everything you do. And that's something that the firm I'm with still continues to do. That's one of the ways we market. It's top of the consciousness marketing. My image is that you've got some sole practitioner CPA sitting in his office. He's on the phone with one client. He's got a client sitting in the chair across from him. And he's being asked to come up with a referral to some tax attorney, and he's got letters on his desk that to which he hasn't responded. He's got a client there waiting for him, and he looks on the desk, and there's all these letters from the law firm with which I'm with, and he says, just call Givner. And so we're trying to deluge him with, of course, nowadays it's not letters as much as it is emails, but top of the consciousness marketing. And I remember I would always give speeches to CPA groups, and in those days there were enrolled agents groups. There's still a few of those left. One day, after giving speeches for several years, and I think I'm still a very good public speaker, but I was speaking to a group of enrolled agents, and there weren't many of them. There were maybe 10 people in the crowd, and they were wearing polyester short sleeve shirts with their ties coming down over their bellies. And I've been practicing for 4 years, but I was a good public speaker. And I said, what am I doing speaking to this very small group? I must not be lowering myself to speaking to such a small group. And then they called the name of the next speaker. And the next speaker was Bruce Hochman. Well, Bruce Hochman, for those who do not know, he's been dead for about 12 years. To this day, he's still the most famous tax lawyer in the history of the state of California. So when they called his name as the next speaker, I realized, oh, you're not such hot stuff, number one. And number two, that's part of the way he became to be Bruce Hochman, was he would speak to every group if there were 2 or 3 people. So I learned part of my early lessons in marketing from first my boss, Howard Sanger, and second, the legendary Bruce Hockman.
You know, it's interesting that you would bring that up because, and you've given credit to those people many, many times over the years when we've talked about such things. I've had great mentors in my life also, whether it be sports or entertainment or the financial services business. There's not really any way to learn that stuff out of a book because there's so many intangible pieces that the books just don't cover. So talk to our audience about the type of planning that you specialize, you specifically, and in the office in general.
Well, the practice that I follow is in 4 primary areas, which is in ordinary income tax planning. We can certainly help reduce earned income. You cannot eliminate earned income, but you certainly in some very conservative fashions can reduce earned income. When it comes to passive income, the other form of ordinary income, you can definitely reduce it and potentially even eliminate it with some very interesting planning. And ordinary income tax planning is certainly the most difficult, the most challenging of the 3 areas of tax law. The second area is capital gains tax planning. And there are, I say, 20 ways to reduce, defer, and even eliminate it. People think of capital gains tax planning as 1031 exchanges or charitable remainder trusts or dying, where you get a step-up in basis. But there are, in fact, many, many other ways to reduce, defer, or eliminate capital gains taxes. And, you know, with the average client, we don't go through all 20. We make a distinction based upon timing. Usually, the farther in advance the client comes to me, hopefully 2 years in advance for some plans, the better off the planning will be and the more tasty, conservative it will be to the client. So timing is one way we pick among those 20 techniques. The size of the transaction is very important. Things we can do with a $20 million gain, we can't do with a $200 million gain. So timing, the amount, and the nature of the asset. So if you have unleveraged real estate, that allows you to do certain things. Whereas if you have S corporation stock, that's much more restricted. So again, ordinary income capital gains tax planning. And then the easiest of the 3 is estate taxes. When I graduated from Columbia back in 1976, before I went to the NYU Masters in Tax Law program, one of my professors, George Cooper, wrote an article in the Columbia Law Review, and it was entitled Estate Tax, a Voluntary Tax. So it's George Cooper wrote in 1976. Nothing's changed since then. You've said this, and you know we can paraphrase it and say, he who fails to plan plans to fail. The estate tax to this day is a voluntary tax. So in order, the ordinary income tax is the most difficult with which to deal. Capital gains tax is significantly easier, especially if you do it in advance. And the estate tax is far and away the easiest. The last area of my practice is asset protection planning. And that's because asset protection planning rests on 3 legs. One is retirement plans, both state and federal, are very much protected from creditors. Estate tax planning, the same structures that reduce the value of assets for estate tax purposes, make them less attractive to some future creditor. And the last leg are irrevocable trusts, which are not tax motivated trusts, which is why we set up trust in Nevada, South Dakota, one of the other 14 states, and sometimes offshore. So that's what I do. The rest of the firm does international tax, real estate tax, go to tax court, go to probate court.
So you mentioned that you built your career basically by doing speeches and creating relationships with CPAs specifically. How about people in financial services, assets under management, insurance people, et cetera?
So, I mean, very early on, you know, I had met legends in the industry, but even before I knew you, remember Bob Shader, may he rest in peace. He's been dead for nearly a year now. And we, you know, I've always, look, in insurance, I think I've told you before, I have both professional reasons to favor cash value life insurance, and I have personal reasons to favor it. The professional reasons are everybody who walks in, almost everybody who walks in is underinsured. And I mean, that happened very early on when I was talking to, clients that walk in when we started doing living trust back in the 70s. And it was always interesting to see that, and typically those were doctors in those days. So the husband was the doctor and the wife was not. I'm not trying to make a sexist statement. That's just what it was in the 1970s. And you would find the doctor, this is in the 1970s, had $1 million of death benefit, which was a lot of money in 1975. And the spouse, the wife, had no death benefit at all. And I would say to them, well, wait a minute. If the husband, I'm sorry, if the wife dies first and you've got a 5-year-old and a 7-year-old, wouldn't you, husband, want to be able to work less and take a bigger role in raising your children? And they would go, well, yes. I said, well, then wouldn't you want to have $1 million of death benefit on your wife? And they'd go, yeah. And I'd say, there's lack of insurance here. And only one time in all those years did the husband actually say to me, no, meaning he wouldn't want to spend more time. I went, oh my God, you wouldn't want to spend more time with your children. So, professionally, I always found that the people were underinsured in one way or the other. Okay. And then federal tax law just tells you that life insurance is a great thing. I mean, there's no tax on the inside buildup. You can borrow the money tax free. And Section 101A says the death benefit is income tax free. And I always point out to the clients, Section 101 starts about 70 code sections that say what is not taxable income. And the very first section is 101, which says death benefits are not taxable. I say to the client, the second one, 102, says death benefits, your inheritance is not income tax free. Think about the public policy that Congress is saying to you. Life insurance is more important as a death benefit, free than your inheritance. And people don't understand, what you inherit from your parents wouldn't be income tax free, but for Section 102. So Congress is telling you something right there. So professionally, you got to believe in life insurance. There's only 4 tax shelters in the Internal Revenue Code: charities, pensions, charitable remainder trusts, and life insurance. And people don't see that. So that's professionally. Personally, my parents were introduced by my Uncle Art, and my dad was trying to help out Uncle Art. So my dad overbought life insurance and disability insurance. And when I was 8 years old, my dad came down with multiple sclerosis. Well, thank God we had all those policies, because otherwise my family would have been quite poor. And then when my dad died, we wouldn't have had all that death benefit. So I have both professional and personal reasons to be in favor of cash value life insurance. And Howard Sanger was a big, speaker to insurance agent groups and was very respectful of the referrals. And we would follow and keep track of the referrals from insurance agents to at least the 3rd generation. So if Bob Shader referred us a client, and then that client referred us a client, and that client referred us a client, we kept meticulous track that it came from that guy originally. So we were very respectful.
It's interesting because I've always found, and I've never talked to you about that specific thing about how far down you track it, but I know probably some of the best thank yous that I ever received was generating an opportunity for somebody who had referred something to me years ago that they never expected. And that's kind of what you're saying. That creates a level of loyalty and professionalism, et cetera, et cetera. How about assets under management people? I've heard how you can help people in the insurance business. How do you help people with assets under management as a career focus?
So if you think about both estate tax and it's easier with estate tax because to describe it, but obviously if you've got a family that's got a taxable estate, well, nowadays that's got to be a big number, right? But let's say you've got, and I'm working with an example with an assets under an AUM person with a family up in Washington. And this family is worth $50 million. Well, think about it. Even with a $23,160,000 gift and estate tax exclusion, on $27 million, what's 40% of 27 million? It's about $10 million. So by eliminating the estate tax, which I can easily do on that $50 million estate, the insurance agent referral source knows that upon the death of these two elderly people, there will be another $10 million of assets under management for the children with whom he is very close. So the AUM guy is very happy that when the two elderly people pass away, which won't be more than another 5 years, given their advanced ages, he will have an extra $10 million to manage. So he's very happy about that. In terms of capital gains tax planning, I have a matter I'm working on right now, which is about a $50 million capital gain. And we're gonna not pay tax on we got it appraised at 10, and we're able to divert the other 40 to the tax-free money box of an insurance policy. So the insurance agent's very happy because he's got $40 million in the insurance policy, which is not subject to capital gains tax. So he's doubly happy. There's no 33.3% tax on the 40 million, and it's all in an insurance policy. He's really happy with that. And then when you go to ordinary income, I'm almost done. And when you go to ordinary income, to the extent that you and I are using a defined benefit pension plan, well, the insurance agent's very happy because, you know, instead of $200,000, there's $400,000 in the pension plan.
You know, what's interesting is I think what you just described is how you have a proactive combination between the person that sells insurance and the person that does assets under management. Even though they come at it from a different direction, the fact remains is when you put those pieces together, you wind up with a whole that's greater than the sum of its part. Am I hearing that right?
Sure. We want all the professionals to get along and be happy with each other. So when the client starts what you always call dividing the professionals, right? He talks to one person and he's looking, and then he calls the next professional and he's trying to divide and conquer them. That's why you always emphasize everybody should talk together so the client can't divide us.
Get everybody in the same room, hearing the same things at the same time with the same level of urgency.
Well, by the way, Stuffy, it's like what I learned at the Mayo Clinic when I was there in December, right? I met with the first physician. When I met with the first physician, he'd already spent 3 hours talking to the other 4 physicians on my team, right? But when he was done talking to me, he then called every other member of the team and told them what he learned, which is sort of what you've always said about, you know, what if the client calls me, right? Yep. Then my job is to call or email every other member of the team to let them know what the client told me so that the client can't divide us, right? So it's the same kind of, you know, interconnectedness.
Okay, Bruce and Simon, thanks for letting me cut in. I wanted to remind everyone that we have our Center's Virtual Academy next week, December 7th through 9th, from 8 a.m. to 3 p.m. Pacific time. We sometimes end a few minutes late, but we try to stay pretty close to those times. To register for this event, you go to our website, www.yourctsr.com, and under the upcoming events tab, you'll see it'll drop down and tell you how to register for the event. It's $495 to attend 3 full days. If you register in the next 48 hours and you enter the promo code BG, capital BG10, you'll save an additional 10% off. For more information, feel free to reach out to us at 877-258-2837. Or if you prefer, you could email us at thecenterteam@yourctsr.com. Let me show you a few of the folks that are going to be speaking on top of Bruce and Simon. We've got an amazing group of speakers, and our faculty for the upcoming academy includes a lot of these folks. I won't read through all of them, but I'll give you a few highlights here. Bruce Givner, who obviously you're listening to today, along with Simon Singer. We've got Kevin Knebel, who is the expert's expert on utilizing the power of social media. In fact, he is the #1 sought after business speaker in the US right now. And he's going to be spending time with us at the Academy. We've got Joe Struzzari, who is the creator of the Southern California Institute Laureate Program, training CPAs and tax attorneys. Amazing smart guy. Vince Donato, the all-time producer for Guardian Life. Walt Dallas, who is another tax attorney, and he's going to be discussing tax reduction plans. Will Duffy was the #1 leading producer with Ohio National and is an incredibly smart producer today who's going to share some of his ideas and concepts. Rick J., who is an ESOP expert, talking about that concept for clients. Jason Kirchner, Jerry Minardi is the co-founder and managing partner of Selling Technologies, video marketing pioneer, show you some ideas and concepts for increasing your marketability with your prospects. We've got Mark Pace, who's a national expert and a member, national expert in life insurance policy management. Steve Pasek, who's a master's of tax attorney and CPA, who does tax reduction plans for our members and their clients. Dan Zeppelin, who has the best senior settlement format that I've ever seen in my 35 years in the business. So that and several more will be leading up to our upcoming event. And again, that is the 7th through the 9th from 8 a.m. to 3 p.m. You will walk away with hundreds of thousands of dollars of potential revenue increase for your practice. That's what we do. The center is a membership organization. We're not a broker dealer. We're not an IMO. So we're all about education and increasing practice revenue for our members. So you can, again, go to www.yourctsr.com. For those of you that are a little bit more tax savvy, just go ahead and hit the scan me on that code to the right, and all the information will pop up on your phone. And again, don't forget that code. If you want to save a few dollars, type in code BG10, save 10% off. And if you have any questions, reach out to us, 877-258-2837, and we'll get back to you quickly. All right, and enjoy the rest of the interview.
I think you've met Dr. Galpin. Dr. Galpin is working on informatics in medicine right now, trying to get all of these various institutions and scientists and physicians around the world sharing information, as opposed to, trying to keep it hidden under a rock. The end result for everybody, patients, society, is significantly better. And the same thing holds true in the tax world. And so what kind of unique things, without giving away any intellectual property, you had mentioned that some of the capital gains treatments take time. Can you kind of talk a little bit about what part time plays in the planning?
So the most conservative structure we can do, and this works best for real estate or a business that's not growing very rapidly, okay? And the most conservative thing is we set up a complex trust for the children. Complex meaning it pays its own taxes. So let's say you've got a building that's worth $10 million and you're planning on selling it in the next couple of years. So what we do is we sell it to let's say it's $10 million. We sell it to the Children's Trust for $10 million. The parents put $1 million of cash in the Children's Trust. The Children's Trust uses that million as a down payment, and they give the parents a note for $9 million. So let's say we do that on January 1st, 2020. If the Children's Trust holds that until January 2nd, 2022, then the Children's Trust is entitled to use the $10 million purchase price as its basis for the future sale. So if the Children's Trust sells it for $11 million on January 3rd, 2022, in other words, I'm focusing on a 2-year and 1-day holding period by the Children's Trust, the Children's Trust only pays tax on the excess above the $10 million it paid. That's a very conservative approach. What we're planning around is that Congress put in a rule. It says if you sell something to a related party and within 2 years the related party sells that thing, the related party doesn't get the benefit of what it paid you. So if we sold it, let's say we sell it to the Children's Trust on January 1st of 2020, and the Children's Trust sells it on January 1st of 2021, the Children's Trust doesn't get the benefit of the $10 million purchase price. The Children's Trust basis is the same as the parent's basis. So we're working with that rule. We're just waiting the 2 years and 1 day. That's very conservative. It's very inexpensive for any kind of gain. You don't need an opinion letter from a tax lawyer. So that's an example of something that's very conservative. But what if the client comes in and they're going to be closing in 2 months? Do we have structures for that? Of course we do. And there's 2 things you can do after a sale closes to reduce, defer, or eliminate the capital gain. So there's always stuff you can do. It's just you have more and more conservative stuff if you do it in advance.
Of course, then people are going to have to make some kind of a decision in advance. I'm going to sell, because if somebody comes along in 6 months and offers them some kind of a great price that they don't anticipate, the bottom line is go do it. It's
Yes.
worthwhile, pay the tax.
Sure. I mean, yeah. And when we set up those 2 year and 1 day in advance things, sometimes, it doesn't happen often, but sometimes the client says, yeah, I got a deal, I can't wait. And then they sell it. Sure. It happens, of course.
Are you going to be able, considering now that the 2 years and 1 day has not been accomplished, somebody sells it in 6 months, they're going to have a little bit of a time period, at least from when they had the offer to when they actually finalize the sale. Anything you can do to help those folks?
No, once they're locked into that, I can't salvage that transaction, but can I do other planning? Sure. If they give me some kind of time, yes, we can put in some other kind of plan. Sure. It doesn't prevent us from doing other planning.
That was my point, because I all of a sudden the situation changed, so you have to adapt and you have to change, and worse comes to worse, they pay the tax, right?
Yep. Okay,
so in the middle 70s and the early 80s, pension plans were a big deal.
Yep.
And I have a feeling they're going to be coming back. Maybe not tomorrow, but more likely than not. We got a $26 trillion deficit right now. The government's going to need money. Would you anticipate income taxes increasing somewhere in the future?
Well, it's going to happen somewhere in the future, but my view of the election results is that it's going to be difficult to raise taxes because you've got 2 seats in the Senate up in Georgia, and the chance of the Democrats winning both of those is very, very low. Number one. Number two, if the Democrats win the seats, they will win by something on the order of 1%. So if they win by 1%, those 2 senators who become Democrats, or the seats, if they become Democrat, they're not going to have much of a leeway to vote for tax increases. They're certainly not going to have much leeway to vote for an estate tax increase in Georgia. And then separate from that, you've got 3 senators up for re-election in 2022 who are Democrats, who last won their races by less than 10% of the vote. Now, they are from states that Biden won, but for them to vote for an estate tax increase when they won by less than 10% of the vote, that's going to be risky for them. But most importantly, there are 3 senators who are Democrats who are from red states that Trump won. In one case, Joe Manchin, a state that Trump carried by 39%. Can you imagine Joe Manchin voting for an estate tax increase? Not on your life. And I think it's fair to say that those 3 senators who are Democrats, who are not up for re-election, but from states that Trump won handily, they're not going to vote for an estate tax increase. So the fact that Biden won, I think, in terms of the estate taxes, is completely meaningless. Now, I'd make a lot more money, of course.
Oh, yeah. So right this minute, January 1st, 2026, the estate tax law is going to revert back to the 2018 law, yes?
2010 law, basically. Yeah. I mean, it's going to be 20. So the estimate had been that it was going to be 6.4 million per person, cost of living adjusted from 5 million back in 2011. But no one knows what the number is going to be. I think the cost of living has dropped dramatically from the last estimate. It probably won't be 6.4. It'll be something more like 6.2. But your point is a good one, that it will be going down. Yes.
And that's without a change in party that's controlling Congress. That's the way the law is right now.
Absolutely correct. So what's happened is, as you know, Stuffy, when the election was gearing up, go back to July, August, September, October, when the polls were showing that the Democrats would capture 53 seats in the Senate. In other words, it would have been 53 senators who were Democrats. There was a lot of panic, last minute estate tax planning. We were deluged with work because people were saying, oh my God, not only was Biden going to win, but the Democrats were going to control the Senate. Well, people were absolutely convinced that the estate tax would be increased, and the numbers you heard were all over the place. So there was a lot, but now the panic is gone because, at least in most places, I mean, there's a lot of lawyers still scaring people and saying, oh, the Democrats are going to win the 2 seats, and then Biden will have the tiebreaker with Kamala Harris. That's just not going to happen.
Are you being ultra conservative in that opinion, or?
I think, look, predictions are worth what you pay for them. Is my prediction true? Of course not. I'm guessing. So you're paying me nothing for my prediction. That's what it's worth. That's my best guess. And I'm giving you the reasons why. I think there's 8 senators who are Democrats who are going to have great difficulty voting for an estate tax increase. And of course, of those 8, 2 of them don't exist yet. And the chance of them winning in Georgia is really small. I mean, Biden won by 0.3% in Georgia.
Yeah.
So, what's the chance 2 senators who are Democrats are going to win over 2 incumbent, Republican senators? I wouldn't put a whole lot of money on that.
I remember something when you're talking about mentors, because you've been a mentor of mine over the years. We sat in a meeting, and the client said, or the CPA said, I forgot exactly what it was, what happens if the IRS changes the law? And to this day, I remember you saying the IRS doesn't change the law. Congress changes the law, which completely changed the temperature in the room. It created an awareness of mine of how important it was to have professional advisors on your team, not to exclude them, but rather seek them out, and then become a good refer source, become a good partner, become more educated, because you guys know a lot more about the tax law than I do, and you've got a lot more credibility than I will ever have. That combination of pieces, maybe to the average consumer, maybe I communicate better, but I don't communicate better to the CPA, and I don't communicate better to the other attorneys. So it's this play of combination of skills without being frightened, which I was for the first 20 years of my career, being frightened that the professional advisor was going to kill my deal.
Right.
And what I learned, and you'll remember the case in Youngstown, Ohio, what I learned was the reason they kill my deal is they didn't understand what it was. I might be embarrassing them. I don't get them paid. And there wasn't much in there for them to say, yes, you're very lucky that Simon Singer came along. He knows this stuff better than I do. That piece of working together has been a very, very significant improvement to my practice. So I thank you for that.
Well, I think I pointed out to you that the CPAs and the other lawyers are deal killers. And, part of what I was trying to get to you, which you now do really well, is citing code sections or citing cases. And that backs them off a little bit. And they go, oh, when you cite that case, they go, oh, I can't run this insurance agent over because he just cited a code section to me or a case, and they have to back off. And that's part of it.
I barely knew Section 101 when we first started to work together. Then it evolved to 72, then 7702, and all of a sudden it was 414 MN and O.
Right. And when you say that, the CPA goes, it jars them because they are not used to citing code sections. They talk in terms of concepts. So when you throw the code section at them, they go, oh, that backs, and it certainly backs off the lawyers too.
It says that I'm dealing with a different kind of individual. That was the key. I don't have to be an expert in those areas, but I'm different.
Yep.
I think you might remember we worked on an old man in the Pacific Palisades, and he had an existing attorney, and I decided to call the attorney on the phone, find out what he knew, and when it was obvious he didn't know not a lot about philanthropic planning, this old man's first name was Lou. I asked him if he knew you, and he said, well, I know the name, but I don't know him. I said, well, would you like to work with him on this? And he said, I'd absolutely like to do that. So being proactive with the professional advisor has been a big time play. Talk to me a little bit about we know about the income tax deductions on qualified plans. We know about the tax-free growth and the asset protection elements. Think O.J. Simpson. Are there ways of being able to reduce the income tax on distributions from those retirement plans, A? B, are there ways to be able to increase contributions to retirement plans when people are being told that they're fully funded and maxed out? Now, I'm not asking you to give intellectual property away. I'm just asking you for, are there ways to be able to do both of those?
Yeah, we want to be careful what we talk about, but certainly the answer is yes. And certainly the answer is to all of your very sophisticated members, they understand estate plan. And let's not answer that question, and let's talk about estate tax planning. Everybody, I think, all of your sophisticated members understand the I should say 80% of our practice is in the firm of which I'm a member, or of which I'm a part, let's say, put it that way. 80% of our practice is wealthy real estate families. So if someone comes to me and let's say they're worth $100 million of income producing real estate, what's the first thing we do? We throw all that real estate into a family limited partnership. And we like the family limited partnership because it helps with asset protection planning. It can help with capital gains tax planning. It can help with income tax planning, because you and I have done a number of them where, we set up the general partner as a corporation, and we put a pension plan in the corporate general partner, which shocked everybody because it was all passive income. But we set it up so that the president of the general partner was getting paid a salary, and we put away, 400 grand in a pension plan where there was $2 million of passive income. But in any event, but we do a family limited partnership mostly because we're trying to get a 40% combined discount for lack of marketability and lack of control for all that real estate in there. So instead of dealing with 100 million, we're only dealing with 60 million. It makes it a whole lot easier to get rid of $60 million of wealth for estate tax purposes than it is to deal with 100 million. Because if you're using a private annuity or some other sophisticated device that's based on cash flow, it really boosts up the related cash flow. So we're not going to talk about pension plans like you asked me to do. We're going to talk about, are there ways to reduce the value of the assets? And the answer is all your sophisticated members know that there are ways to reduce the value of assets, right?
Yeah. And the bottom line is most everything with regard to capital gains tax planning, income tax planning, estate tax planning, asset protection planning, it requires certified appraisals. It requires very talented, very credible people that value the assets. And if I can remember this correctly, I think that what I used to say with regard to estate tax planning was that there's 7 things you can do. It's sales, it's gifts, hopefully it discounts, there's charity, there's non-charitable deductions, and there's life insurance. And that's about it. Lots of subsets, lots of combinations, but everything really comes down to those pieces. And if you orchestrate them correctly, you can wind up with exponential results. And you're the master of exponential results.
Why don't you tell the story that you tell about the chef?
The chef, the second most famous chef in Los Angeles. We were talking about grats and grits and partnerships, and he said, I know all about grats, I know about grits, I know about life insurance. What's the big deal? And I said to him, well, let me ask you a question. Did you invent pasta? He said, no. He said, did you invent pasta sauce? He said, no. I said, well, if you didn't invent those, why can I buy pasta and pasta sauce down the street for $5 a plate? And at your restaurant, I pay $50 a plate. And he said, that's very easy. It's the way I put it together. And he stopped and he went, oh, I see what you're talking about. So it wasn't the item, it was how the item was used in combination with other items that produced exponential results for his restaurant and exponential results for us. By the way, we never got that client.
No, I think we did do some work, but your expression is, it's the timing, combining, and sequencing of known elements is our intellectual property. That's the way you say it.
Yeah, I know. I think I might patent it, but it's public knowledge by now. So, but that's exactly what it is. And I know I probably stole it from somebody else. But I said it 3 times, turned around, and it became mine. So you're going to get into a little bit more strategies, a little bit more technicalities at our Academy meeting next week. So I don't want to, because you probably only know another 5-10 minutes worth of stuff, so I don't want to use it up here. I appreciate the time today, Bruce. I look forward to seeing you, at least video-wise. Glad you're feeling better. Glad that problem with your foot is healed. And we'll talk soon. Thanks again.
Pleasure talking to you, Steffi. Have a lovely rest of your day.
Take care. Bye-bye.
Bye-bye.
Okay, well, thanks, Simon. And thank you again, Bruce. It was great being able to listen to you discuss how you have collaborated. And Bruce, it's great to have you as one of our faculty members for the Center for Tax Strategies. Looking forward to your presentation coming up here next week. And again, another reminder, December 7th through 9th, so that's next week from 8 a.m. to 3 p.m. Pacific time. To register to attend the virtual academy, go to www.yourctsr.com, and there's a tab that says upcoming events. Click on that, it'll give you all the information. It's a $495 investment. However, if you register in the next 48 hours, enter the code DG10 and you'll save 10% off that $495. If you need additional information or you want questions about membership or about the academy or anything else, feel free to call us at 877-258-2837 or email thecenterteam@yourctsr.com and one of our staff will get back to you quickly. For those of you that are tech savvy, again, you can go ahead and scan on that on the block to the right, and that'll bring up all the information right onto your phone. Hang around for a couple minutes too, because we're going to have a couple of our members just asked to be able to say a couple words about how the center has made a difference in their practice. So if you have a minute, go ahead and hang on for that. If not, we look forward to seeing you at the Academy, again, the 7th through the 9th, and good luck and stay well. Thanks.
One of the reasons that attracted me to the center was Simon Singer and his ability to focus on the language that we use in our relationships with our clients.
Yeah, what attracted me was really the ability to obtain decades worth of experience and problem solving and solutions in a short amount of time. The way I looked at it, especially with Simon's experience and time in the business, was I could either go put in decades worth of work to get to where he's at, or I could join and learn it all in a short order. So the purpose for me was to try to just use other people's experience and time to accelerate and ramp up my business and get there much sooner.
Yes, Simon had sent an invite and we did the webinar. I was kind of still, been membership about maybe 3 months with the center, and pretty eye-opening. It's a nice strategy where to take qualified money and put it in a IUL product, and kind of unique strategy. Come in the second year, make another deposit from the IRA, and then immediately use the interest rate arbitrage to take the loan out and pay the tax from the first year. And pretty nice, and still kind of amazed on how they can manipulate the policy, the Experian that they use, i.e. the life, to make that happen.